I don't believe any of these answers. I mean, they're just this is nonsense.
No, the whole thing about the venue thing, well, we found it. No, you didn't. No, I'm going to tell you exactly what happened with that because I told everybody from day one the whole venue thing was going to get – there's no way the venue thing was ever going to happen. From day one, I said that, and guess what? Derp to derp to derp. Here we are. I'm going to tell everybody why.
Don't cite ratings, Valiant. Don't cite ratings, though, because they don't look at those.
Oh, yeah, we don't look at ratings. We don't look at ratings season to season. Bruh, you just tripled your fees with the NBA to like $2.5 billion a year from your previous. Don't tell me you don't look at ratings. You are so full of crap.
Overall, we're very encouraged by our results this quarter, and we'll be happy to take your questions.
Yep, that's it. Very abbreviated remarks.
Thanks, Bob. As we transition to Q&A, we ask that you please try to limit yourself to one question in order to help us get to as many analysts as possible today.
So they're not talking financials at all right now.
We're ready to take the first question.
Thanks for your question, Ben. Regarding the timing of the different technological advances that Adam and his team are working on, they're actually starting to roll out already and will continue to throughout the next 12 months, but we're not going to obviously stop at the end of the year. I wouldn't really call out any one of them in terms of one of them having a greater impact than the others because it's a collection of them. You mentioned paid sharing. That's certainly one. Using technology more and more for personalization and essentially upping our game from an algorithm perspective, getting less out of our control or curation and more basically into the business of serving the consumer what the consumer wants. We've got some work to do internationally,
Real Star Wars.
Particularly on the ed tier. Ad tech is also something that we're working on. A variety of different AI initiatives going on.
It's clearly not working.
And we're also developing Flagship. I'd say that of all of them, one of the things that we are very, very mindful of is that home screen or front screen or the first experience that consumers have has to be more dynamic. Ours was elegant looking but fairly static in nature. The more dynamic it is, the more people are drawn into it, the more people use it, the more people don't basically close the app out and go elsewhere. You know, that's a big deal. But a lot going on. We're still building his team out. And I'd say that by the end of the year, there'll be significant progress made, but we've already made some progress. We've made some progress already.
He's stalling.
Does he really think that the problem with Disney Plus is the home screen?
Obviously, lastly, I have to ask, you have guidance for high single-digit earnings growth for the year. Started out with earnings growth of over 40% in the first quarter here. Can you just talk a little bit about sort of the cadence of the earnings growth as we look out through the rest of the year? Thanks.
Given the rapidly evolving macro environment, we think it would be premature at this point to change the guidance. That said, to the degree that the business momentum and the business performance justifies it, we're certainly not a management team that's afraid of over-delivering if, in fact, that is where the business takes us. So, generally speaking, feel better about the balance of the year, and we started out the year feeling very, very positively about it.
That was vague.
Thank you, Hugh.
Thanks, John.
Management's not afraid of over-delivering.
On the NBA, can you talk about how you view the path to profitability in the new contract, given the weaker season-to-date ratings and obviously the step-up?
That's a good question.
And then on DTC?
In the NBA, we don't talk about profitability for any one of our licensed sports packages. We obviously believe in the NBA long term. It's a great sport. We think it's a growth sport. We don't really look at ratings year to year that carefully. First of all, we haven't even seen half a season, but we're not.
You don't look at ratings.
He is ratings-wise in the NBA this season.
What a line son of a bitch.
We're happy to have it for now 11 more years, including the finals 10 of those years, and it is and will continue to be a marquee part of ESPN's offering.
What TV station doesn't look at ratings?
Clearly have demonstrated over the last couple of years the ability to do that, and we are confident that we will deliver on a consistent basis high-quality films and television over the long run. Second, you need really strong technology.
Platitudes.
And this is where we have, as we have said very publicly, well, I think we've all seen the benefit of live. Just look at ESPN's ratings, for instance, or talk to anyone in the advertising business. Live is
basically, we are further into the curve, but the messaging is exactly the same as I gave you last quarter. Bookings are up in the summer right now, so certainly feeling positive. And obviously, we have more of them in, given that we're 90 days later. So certainly the outlook is good in that regard. But as always,
statistics.
We're going to take a view at this point that it's premature
Bookings are looking up over the summer.
Guide in that regard.
Okay,
but
compared to what?
Off to a great start in experiences.
Compared to last year's summer?
Great.
Compared to this quarter?
Compared to yesterday? Who knows?
And then secondly, just on Disney Plus, if you could talk about the outlook for Disney Plus subscriber growth this year. I think you're guiding to essentially flat subs through the end of 2Q.
Yes.
What are you expecting in the second half of the year directionally, and what are some of the key factors that are shaping the outlook for the rest of the year? Thank you.
I think I know what it'll say.
Well, they're looking bright.
Yeah, so in terms of ESPN and the NBA, obviously there are a lot of variables that go into
we're not afraid to over-deliver.
P&L, including the advertising market for live sports, which is obviously very, very strong. As I said earlier in the call, we mentioned low single digits next year. We're still very much committed to that based on the aggregate of all of those inputs. In terms of outlook for DTC subscribers, our expectation is to grow.
Let's get excited.
So,
maybe not even inflation.
We're basically sort of slightly up in the first quarter. We'll be similar in the second quarter. Our expectation is, particularly as paid sharing starts to take hold, and as we add more of the movie slate that we produced in the back half of 24 into the streaming service in 25, we think that content will drive sub growth as well.
The data does not bear that out.
I'll add to what you said.
No.
We actually are very pleased with where we are sub-wise for Disney Plus and Hulu. As you know, we took
No, you're not. You lying sack of crap.
Fairly recently, and expected the churn would be significantly greater.
You're
and it
such
turned
a
out
liar.
we delivered numbers that were better than we had expected. So the combination of Disney Plus and Hulu, actually, we grew subs modestly in the quarter.
Because people got confused.
Now, while we did that, we also are implementing, as we talked earlier, these technological advances or enhancements that will enable us to lower churn and continue to grow subs. And we also have a great product pipeline coming.
Maybe on ESPN Flagship, Bob, just in terms of the vision that you have for the product and the objectives with that service, is this to basically further grow the sports business relative to where it is today, or is it more to preserve existing profitability and preserve the ecosystem as it is today? It'd be great to get your thoughts on that.
Regarding Flagship, look, it's pretty clear that young viewers, I guess you call them, or young consumers, are leaning more and more into streaming experiences, both fixed televisions on walls and mobile devices. And the more ESPN can be present for a new generation of consumers with a product that serves them really well, the better off ESPN's business is. So Flagship is not really designed to preserve a business. It's designed to grow a business in a market that's evolving or changing right before our eyes. So we're extremely excited by what's coming and bullish about it, because we think it's not only a good business proposition, but it's a sports fan's dream.
Thank you.
That was nothing.
Thanks, Kanan, and thanks everyone for your questions this morning. We want to thank you for joining us and wish everyone a good.
All right, let's go ahead and let me grab some super chats here real quick, and then we'll get into discussion, because that was a giant heaping steaming pile of BS.
I don't know what I'm more mad at. That A, I got up early for this. B, I went to bed early.
Archer for 5. Thank you all for sorting through the BS so we don't have to. Maybe they also blame USAID next. Yeah, right. I do
feel like Disney has operated like the last executive administration for the U.S. government. Like I don't believe any of these answers. I mean, they're just this is nonsense.
No, the whole thing about the venue thing. Well, we found it. No, you didn't. No, I'm going to tell you exactly what happened with that because I told everybody from day one the whole venue thing was going to get – there's no way the venue thing was ever going to happen. From day one, I said that, and guess what? Derp to derp to derp. Here we are. I'm going to tell everybody why.
Don't cite ratings, Valiant. Don't cite ratings, though, because they don't look at those.
Oh, yeah, we don't look at ratings. We don't look at ratings season to season. Bruh, you just tripled your fees with the NBA to like $2.5 billion a year from your previous. Don't tell me you don't look at ratings. You are so full of crap. John Apocalypse, all I hear from Bob is a lot of weasel words. Is this what it feels like to you guys or the investors? I'm autistic. John, yes. No, it was weaselly. It was definitely weaselly.
There were no numbers at all other than single-digit growth, low single-digit
OI, operating income growth.
You know what else has low single-digit growth? Inflation.
Yeah.
And to the extent like they bragged about Mufasa, and there was some comment in here. I'm going to scroll back up. There was a comment in here that I wanted to – actually, it might have been on the other one. In some of the Iger remarks, I believe.
They're really happy, though, Valiant, with where their subscribers are. In the same quarter that they lost 700,000 subscribers while essentially giving Disney Plus away for free. We saw the deals. We saw the $1.99 promos, and they lost 700,000 subscribers. Then Bob Iger comes out and says, we're very happy. We're very happy with our subscriber levels. It's like, at this point, hot is cold, up is down.
Yep.
What do you want us to do, buddy? Like, how else are we supposed to report on this?
Bob Iger's executive commentary, this is what's attached to the earnings call. If you see here, film and television, of course, they talk about our theatrical business had an outstanding run. 2024, fueled by renewed creativity at our film studios. I guess he finally admitting that everything was broken, and it still largely is. Don't think everything has fixed itself. With Disney becoming the first studio in the industry post-pandemic to surpass $5 billion worldwide, they also have released more major $200 million films than anyone else combined. So you've got that going for you. And unfortunately, on most of these films since the pandemic, Disney has lost $1 billion plus since the pandemic and the theaters reopened. They kind of missed that part. Q1 saw impressive performance from Moana 2, which recently crossed $1 billion globally, which, given the popularity of the first one on Disney Plus, that's what we thought should happen with Moana 2. But here's the part that I like. As well as Mufasa, the Lion King. And I've been really scratching my head on the performance on this one, which demonstrated extended appeal at the box office and has attracted audiences for several weeks beyond its holiday release. Disney spent, because I've been seeing the ads, what they don't tell you here is how much extra money Disney had to have spent to drag this thing out. And the kicker is most of that extra marketing budget that they threw behind this to keep driving stuff after it had a relatively kind of weak opening, it all happened after the end of the quarter. It all happened after January 1st because Mufasa came out Christmas. So it only had a week of operation in 2024. Most of its performance so far has been in 2025 on the calendar in the new quarter that we won't hear reported on until May from Disney. But they also pumped in, God knows, an extra 50, maybe $100 million into the extended marketing on this thing.
Right.
When people try to drive it.
When people won't be looking for those numbers there anymore.
Right.
The other thing I'll point out is that the Luminate report that Deadpool and Wolverine didn't even show up on that Luminate report, despite being one of the biggest films in 2024. So I think the case is pretty well being made here that having your movie on streaming can hurt your box office, but the box office does not necessarily correlate to streaming figures, which is another thing that Hugh Johnston was touting on CNBC this morning. So I don't know. It's just trying to follow all the data at the same time here. When you get a complete picture of what's going on, you see all the areas where they don't quite make a complete case here. Like they say Disney Plus, but they want you to get confused and think that it's Hulu and associate Hulu with Disney Plus, even though it's a separate streaming service.
It is, and a streaming service that they have not finished paying for, at least insofar as we know. We know they're going to owe probably another $5 billion. I'm really surprised that that we haven't. I don't think anything definitive has been said one way or the other.
It's not in the statements here. They've got the Fubo stuff and they've got the Reliance deal, but they're not talking about that Hulu deal, which, by the way, hey, we called that on that Park Place that they wouldn't have the Hulu deal done by the end of 2024.
There you go.
This is
well.
All right, I got to sign off.
Mike.
I got some issues going on the East Coast that are waking me up anyways. I got my phone's blowing up. So I just want to give a few parting thoughts as an investor and just tell you what I think and see from my limited seat, which is that I am completely disgusted and disappointed with institutional investors that seem to treat this company like it's some kind of stray puppy that always needs to be coddled and saved. Now, when I sit on these things and I listen to Comcast or I listen to almost any other one of these, there are detailed questions. They have read the report. They're looking at some numbers. They're bringing up old initiatives. With Bob Iger, nothing. We had nothing volunteered and we had nothing questioned. For example, had I been an investor or somebody on this call, I would ask some simple questions like, Bob, typically about your banner flagship offerings in cinema. What are your projections for how your cinematic releases are going to do? And what's your analysis of how the ones have done in this past calendar year that we're just that we just wrapped up? Another one could be, we recently saw that you converted $1 billion worth of what should have been a highly profitable hotel into office space. How did we come to that decision to deploy that asset in that way? Bob, last year you announced that we're going to invest up to $1 billion in something amazing called a Fortnite initiative to take the company into gaming to promote its merchandise and do in-game sales. What is the status of that? And when can we expect that to hit the bottom line? I don't get any of this. And finally, the easiest one and the best one to me would be, Bob, you spent billions of dollars buying, it was about 10 years ago, Bob, that you entered into negotiations and completed a purchase agreement that was then executed to purchase Star Wars. Why now, as we approach damn near a decade later, are we seeing that asset sitting on the vine? What happened there, Bob? But we don't get any of that, do we, Valiant Renegade? We don't get any of that. So as an investor, I am exasperated. I'm kind of having the feeling that I have when people ask me, do I go to gamble? I don't gamble because I don't go to casinos because I think it's a waste of my money because my life is a gamble because on any given day, I don't know what problem I'm going to have to solve for what client. So I always say that I'd rather go take $100 bill, wrap it around a cigar and smoke it because at least I'd enjoy the scent of the cigar. And in this case, I think it is fine. I am now for the first time out loud able to say that I think I should just do what Culture Casino told me to do a year ago. I should sell this stock and just let the 20 or 30 years go by where I'm only going to take a 3% loss because I'm so far upside down with my average cost basis in this piece of crap company. Bob is an awful CEO, and anybody that follows this company and is rooting for it lives in delusion. But I guess that's the world in which we live. Thanks for having me. Sorry I'm such a downer today.
Make sure you're subscribed to Valiant Renegade and join us every Sunday at 6 p.m. Eastern for the live show.